Here is how we explain finance. Finance is the science and art of managing money, encompassing activities such as investing, borrowing, lending, budgeting, saving, and forecasting. It plays a fundamental role in both individual lives and the broader economy, enabling the efficient allocation of resources across time and space. Here are some types of finance. Number 1, personal finance. It involves managing individual or household financial activities. This includes budgeting, saving for emergencies, retirement planning, investing in stocks or bonds, managing debt, and purchasing insurance. Personal finance decisions directly impact one's quality of life and financial security. Effective personal finance management requires understanding income, expenses, assets, and liabilities to build long-term wealth. Here's an example. Sarah works as a teacher earning $50,000 annually. She creates a monthly budget allocating 30% for housing, 20% for savings, 15% for transportation, and the remainder for other expenses. She invests $500 monthly in her retirement account and maintains an emergency fund covering 6 months of expenses. Sarah also pays off her student loans systematically while building her investment portfolio. Number 2, corporate finance. It focuses on how businesses manage their funding sources, capital structure, and investment decisions. Companies use corporate finance to maximize shareholder value through long-term and short-term financial planning. Key activities include capital budgeting, dividend decisions, working capital management, and financial risk management. Corporate finance professionals analyze financial statements, assess investment opportunities, and determine optimal financing strategies. Here is an example. Luke Corporation, a software company, needs $5 million to expand operations. The CFO evaluates options, issuing stocks, obtaining bank loans, or using retained earnings. After analysis, they choose a combination of debt financing and retained earnings to maintain ownership control while funding expansion. They also invest in research and development to create new products that will generate future revenue. Number 3, public finance. It deals with government revenue generation and expenditure management. This includes taxation, government spending, budget procedures, and debt management at local, state, and national levels. Public finance aims to allocate resources efficiently, redistribute income equitably, and stabilize the economy. Governments use fiscal policy tools to promote economic growth and address market failures. Here is an example. The city government collects property taxes, sales taxes, and receives federal grants totaling $100 million annually. They allocate these funds across departments: $40 million for education, $25 million for infrastructure, $20 million for public safety, and $15 million for healthcare services, ensuring community needs are met. Understanding these 3 pillars of finance helps individuals make informed decisions, businesses optimize operations, and governments create policies benefiting society.